Hello, good morning, everyone. Welcome to our usual research weekly call. Today we have many stock counter updates or results, and we have TA and the usual SG weekly as well. So without any further delay, let me hand over the time to John. John, please.
Yeah, thanks, Darren. And good morning, everyone. So I'll begin with some of our US results for the second quarter of 2023. So I'll start with Alphabet. They announced their earnings, I believe, last Wednesday morning, Tuesday night their time. Earnings roughly, were within our expectations, with first half of 2023 revenue and PAT at 47% and 46% of our full year 2020 forecast. The main thing for Alphabet is that earnings growth actually reaccelerated quite significantly after 4 quarters of decline. What the company did well, or what really did well for the quarter, was advertising and cloud, so both of their business segments. If you look at the chart here, services essentially is mainly made up of your advertising revenue, and that grew about 6% year on year, mainly due to strong growth in retail ads. So your retail vertical, which is quite surprising because actually retail sales in the US have actually been declining, or not really declining, but I guess a little bit weaker than expected. And so we're seeing a little bit of more of I guess retail spending from countries that are outside of the US potentially. When you look at the individual components of advertising, search advertising was fairly stable. I believe it was growing about 4% year on year, whilst YouTube advertising actually increased after 2 quarters of contractions. Cloud also did well, and this was in light of some moderation in consumption growth, which is not actually company specific, but it's actually it's been affecting the industry as a whole, especially as more and more consumers or customers are actually trying to spend their dollars more wisely, so that they're not really expanding cloud capacity or purchasing more cloud capacity for their own users. So what Alphabet has actually been able to do is they've been able to grow their user base, and also grow the revenue from the average revenue per user. They've been doing this. They've been able to do this by integrating or improving their products by integrating more AI into it. At the same time, they also have the ability to cross-sell and upsell a lot of their products to their current user base. So fairly healthy growth for cloud. They made up 28% year on year. It is down quite significantly from 2021 when it was growing at like 50%. But as the service starts to, as the segment starts to mature a little bit, you would expect growth to come down a little bit. But 20+% is still very healthy growth for cloud. Like I mentioned earlier, the last positive is that earnings actually grew for the first time. So it was up 15% for the quarter, year on year. There were a few reasons for this. Firstly, top line growth started to accelerate a little bit. Secondly, there were some reductions in total expenses because significant head cuts, reduction in office facilities and stuff like that. And lastly, that there were actually quite a number of restructuring charges that were taken in the fourth quarter and the fourth quarter of last year and the first quarter of this year. And most of these restructure charges were related to downsizing offices where they had to cut your leases. You got to pay penalties for that, and also a lot of severance related charges where they cut it out. In terms of what to look forward to, the last 7 or 8 years, Alphabet is going to continue to integrate a lot of AI into their products, especially in their cloud products. So what was new for this quarter was actually this product called SG. Essentially, it's called Search Generative Experience. It's like integrating generative AI into your normal Google search. So instead of just when you type in searching for whatever you want to find into the search bar, and it'll just show a list of items that you can click on. Using generative AI, will actually be able to. And right now, this is still in beta testing, but it will be able to at least give you a description of what you're searching for, give you a little bit more options in terms of maybe some pictures or some other more intuitive clicks for you instead of just a list of URLs to click from. Another thing that is quite interesting from the cloud segment, cloud products, is actually called Duet AI. So is this AI generated collaborative tool, which essentially is to help a lot of their cloud customers. The key things that management spoke about was actually a lot of customers are inquiring about this, and they see current users of this using some of Duet's AI capabilities for coding assistance. So essentially, what these customers can do is that maybe they type out what they're trying to code, and then this product will essentially give them the whole rundown, the exact code that they require. It may not be exactly how they require it, but it's going to be fairly close. So that kind of saves a lot of time for a lot of customers, especially if they're not really that savvy in programming. Something that Duet AI is also going to be helping with it is creating new applications for the customers. So it's going to make application creation a lot more simple, saving a lot more time for these customers whenever they want to create or edit some of their own products. In terms of capex levels for this past quarter was actually fairly low because there were some delays in projects, and we expect that second half of this year capex levels to increase a little bit because some of these delays will actually move into the second half, and for this to continue expanding and accelerating into the second half into 2024, especially as Alphabet continues its investments in GPUs, TPUs, as well as data center capacity to kind of cater to expanding need for powering AI tools. In terms of our valuation, we actually raised our 2023 PATMI by 4%, and our 2024 revenue and PATMI by 3% and 9% respectively, mainly due to more efficiency from AI as well as a faster than expected recovery in I guess your advertising industry. We maintain a buy rating with a raised target price of $144, up from our previous target price of $131. So that's all for Alphabet. I'll move on to my next counter, which is Spotify. So similar to Alphabet, Spotify's results were also roughly in line with our expectations. The main key thing for Spotify was actually their user growth. So user growth actually really outperformed. They added about 36 million users in the quarter, which is a record for the company. And this essentially is about almost a 30% year-on-year growth in terms of users. So it's quite significant growth. And actually, user growth has been outperforming for the last few quarters already. Similarly, premium subscribers came in at 220 million, which actually beat their internal guidance of 3 million. So growth in terms of premium subscribers is also fairly healthy at 17%. This is quite important because essentially your monthly active users, which is your free to use Spotify users, is the main funnel for the company in terms of converting free users into paying users, and it's the most effective as well because conversion rates are relatively high, and your customer acquisition cost is already very low because these users are already on your platform. And so what we usually see is some sort of delay in terms of premium subscriber growth. So it's like your monthly active users kind of expand and grow first, and then there's a little bit of lag time as some of these guys, monthly active users, convert into premium subscribers. So what actually the company is also focusing on in this second quarter and actually moving forward is they are still highly focused on efficiency, and they expect OPEX as a percentage of revenue to continue declining moving forward. What they actually did in the quarter was they reduced their headcount by about 2% quarter-on-quarter, and they also significantly downsized I guess some of their office or real estate footprints. In addition, they also reduced or they actually cut a lot of underperforming podcasts from their content library. So the biggest cut that they made, or the most I guess popular one that they made, was actually cutting Prince Harry and Meghan's podcast because it didn't meet the performance guidelines that were set out in their contract. I believe this contract was worth about 20 to 30 million US dollars. And so similarly, for a lot of other podcasts that were not really performing, Spotify has gone on and just really cut these costs from their content, saving quite a little bit of money on that end. And they'll continue to be quite prudent in terms of what kind of new investments they make and what kind of new content they invest in. In terms of the main negative, losses continue to widen a little bit, mainly due to restructuring charges. So if you look at operating losses, about 250 million euros, more than half of it came from restructuring related charges, so severance related charges and reduction in real estate footprint. In terms of the outlook, Spotify actually guided to a slight slowdown in MAU growth and premium subscriber growth. So 25% year-on-year for MAUs and 15% year-on-year for premium subscribers, which is, I guess, quite expected because it's quite difficult to consistently maintain such high growth for its users. I mean, 25% is still a fairly high number, so it's not really too concerning. In terms of revenue growth, this is guided to about 9% year-on-year for the third quarter, with 26% adjusted gross margins. The key thing for their outlook is that Spotify actually raised prices across more than 50 countries for their plans. They raised it by like $1 or $2. The thing about raising prices now is that it won't really take into full effect until the September billing cycle. So that's really only 1/3 of your whole quarter in effect. So we should see the full effects of these price increases in the fourth quarter and beyond, which essentially would be a larger. We should expect to see some acceleration in terms of revenue growth for the fourth quarter. In terms of our valuation and our rating, we actually maintain an accumulate rating for Spotify, but we reduced our target price from $165 to $162, mainly because we widened 2023 net loss by almost 400 million euros, while keeping our revenue targets unchanged. I think that's all for Spotify. I'll hand it over to Ambrish for Microsoft. Thank you.
Thank you, Jonathan, and good morning, everyone. So moving on to Microsoft, last week we released its fourth quarter earnings report with the title Stabilizing Cloud Spending. So overall, the fourth quarter results, they were within expectations, with the full year 2023 revenue and PATMI coming in at 100% and 101% of our full year forecast. In terms of its performance for the fourth quarter, total revenue, it grew by about 8% year over year, and after excluding foreign exchange impact, in terms of constant currency, revenue grew by about 10% year on year. And in terms of its bottom line, PATMI grew by about 20%, and this is mainly because of high operating leverage. Like as an instance, research and development expenses, they were actually down by about 2% year on year, and this is mainly because of cost-cutting initiatives from the company, through layoffs and no salary increments. So in terms of positives, Azure, which is a part of Intelligent Cloud segment, it was the fastest growing segment, and Azure revenue, it grew by about 27% year on year. This was mainly because of the continued demand for its cloud computing services, as the companies, they digitize their operations in order to be competitive and reduce their own OPEX. So moving on to the second positive, Office 365 commercial revenue, it grew by about 17% year on year. And this is mainly because of its growth in its paid users, which grew by about 11%. And also revenue per user, it grew mainly because of the companies as they upgraded their license to E5 for its additional security and analytics functionalities. And also company, it plans to charge its for its AI tools associated with Office 365. So it plans to charge per user per month of about like $30, US dollars 30 per month. And we believe that this could provide a tailwind for its Office 365 commercial revenue. And it should be able to sustain its double-digit growth rates. So moving on to the negatives, more personal computing segment revenue, it dropped by about 4%. And this segment contributes like about 25% of overall revenue for Microsoft. And the main reason for this drop was mainly because it's a Windows OEM revenue dropped by about 12%. So Windows OEM revenue, it basically, it's the revenue that Microsoft generates through the PC manufacturers like Dell or Intel, who pre-install Windows software on their machines. And also devices revenues for Microsoft, which mainly includes through sales of its tablets and Surface tablets and PC accessories. So this revenue dropped by about 18% year on year. And this is mainly because of deteriorating consumer demand for personal computers. So moving on to the outlook for the first quarter, which would end in September, Microsoft expects total revenue to grow by about 8% year on year. And the main growth driver would still be Azure. Azure, it's expected to grow its revenue by about 26%. So there is not much significant deterioration sequentially. This is mainly because the management mentioned that it's towards the end of optimization trends, and it could now stabilize. The cloud spending would stabilize, and the AI would also contribute towards its growth. So for the full year of 2024, company said that its capex is expected to increase sequentially throughout the year, and this is mainly because of the AI infrastructure scalability. And despite this, the operating margin is expected to remain flat at about 42%, and this is mainly because of low operating expenses. So moving on to the valuations, we have upgraded the stock to accumulate and raised target price to $372. This is mainly because we have raised our growth assumptions, as we believe that Microsoft, it would continue to benefit from digital transformation trends, and as well as the demand for its AI-enabled products would pick up through the end of the financial year 2024. So that's all for Microsoft. I would now like to pass on to Glenn for UOB.
Thanks, Ambrish. So for UOB, they recently released their second quarter results last week. Yep. For the second quarter, adjusted earnings of 1.5 billion, they were slightly above our estimates, mainly due to higher other non-interest income and higher net interest income, which were offset by lower than expected fee income growth and higher allowances. The first half adjusted PATMI was at 54% of our FY23 forecast. And for the dividends, the second quarter DPS was up 42% year on year to 85 cents. I'll jump straight to the positives. The first positive being that the net interest income grew by 31% year on year. And this is despite a decline in loans growth of 1%, while the NIM surged 45 basis points to 2.12%, but it declined 2 basis points quarter on quarter, and this was mainly due to the excess liquidity deployed to high quality assets. The loans growth decline was mainly due to weaknesses in Singapore and North Asia, which was offset by growth in the rest of ASEAN. UOB has also maintained its loans growth guidance for FY23 at low to mid single digit. The second positive was that the other net non-interest income surged 113% year on year, and this was largely due to higher customer-related treasury income and strong performance from trading and liquidity management activities in the quarter. The management also noted record high customer-related treasury income from increased hedging demands and good performance from trading and liquidity management activities. For the third positive is that their new NPA formation fell by 45% year on year as the asset quality stabilized during the quarter. The NPL ratio also remained stable year on year and improved by 10 basis points quarter on quarter to 1.6%. For the negatives, the first negative is that the fee income growth fell rather short this quarter, and it fell by 8% year on year and 5% quarter on quarter. And this was mainly due to lower loan-related and wealth management fees as the investor sentiments remain more subdued. However, this was offset by a sustained momentum in their credit card fees. For the second negative is that the total allowances rose by 38% year-on-year, as this was mainly due to specific allowance increasing, largely due to a major Thailand corporate account. And management had mentioned that this major Thailand corporate account is in the manufacturing segment and was hit by fraud, for which they had to fully provide for. However, they do not see any systemic risk from this account. And this increase in their allowances resulted in credit costs increasing by 8 basis points year-on-year to 30 basis points. However, they have also increased their guidance for the full year 23 for credit costs from 20 to 25 basis points to around 25 basis points for FY23. Nonetheless, if you look at this guidance of 25 basis points, it's lower than it currently is. So I think they did mention that they do expect that this credit cost will sort of fall off for the rest of the year. For the third negative is that the expenses rose 22% year-on-year, and this increase was due to the continued focus on investments to enhance capabilities to drive strategic initiatives. Nonetheless, their CIR, or cost to income ratio, actually improved by 2.9 percentage points year-on-year to 40.9%, and this was on the back of strong income growth. For the outlook, UOB's profit should continue to grow in 2023 on the back of stabilizing margins, stronger fees, and lower provisions. And we expect that their FY23 net interest income to expand 21% year-on-year. We also expect credit costs to come in around their guidance of 25 basis points. For their fee income, they expect that fee income will recover from the low base in FY22, and for the growth to be led by credit card fees and wealth management, as well as fund management fees, as the market sentiment recovers. They have lowered their fee income guidance from double digit to high single digit, and this could add around 200 million to their revenue. For the loans growth, they expect to see strong demand for loans as cross-border activities pick up, and the ASEAN loans growth is expected to be higher, with some slowdown in Singapore and North Asia, and we have seen that in this quarter. As such, we maintain a buy with a higher target price of $35.90 from $35.70, and we raised our FY23 earnings by 4%, as we raise other non-interest income estimates but lower the net interest income, fee income, and increased provision estimates for FY23. So that's all for UOB. I'll now move over to iFast. Yep, so for iFast, it's a Phillip on the ground. We also released their results sometime last week, and it's non-rated, so we do not cover iFast. So for iFast, their second quarter assets under administrations due AUA grew 3.7% quarter-on-quarter to 18.81 billion, and the net inflows of client assets also remained positive, and it rose by 78.6% quarter-on-quarter. So for their revenue, they actually recorded a sort of a net profit this quarter at 54.2 million, and this is up 0.5% year-on-year, with net profit positive at 3.59 million. And so the layer before, they actually recorded a net loss of 2.69 million. So for their revenue breakdown, they now shifted to where they separated their banking and non-banking revenue. So the banking revenue would be like the iFast Global Bank. So for the non-banking revenue, it's actually up 4% year-on-year, with net profit up 68.3% year-on-year. However, their banking business still reported a loss, and a loss of 2.23 billion. I'll go further into this banking and the iFast Global Bank later. For dividends, it remains flat at 1.1 cents for the second quarter. Okay, so for an update on their e-pension, Hong Kong e-pension business, the targets have not been changed, and they still maintain the same targets which they have held for, I think, about a year already. But they did mention that they recently launched their also e-pension service, which is expected to start making sizable contribution to their Hong Kong's AUA from the first quarter of 2025 onwards. So we should start to see a sort of a trickle more in the rest of the year as well as in 2024, and then it will be even bigger contribution from 2025 onwards. Now, also touch upon their iFast Global Bank. It is still expected to be loss-making in the rest of the 2023, as we can see from the second quarter. But they did mention that this iFast Global Bank is going to play a very major role in the growth in the medium to long term, particularly beyond 2025. So currently, the iFast Global Bank, they provide product offerings such as a basic bank account, fixed term, and notice deposit. They've also said that the bank has reached sort of interested parties in up to over 30 countries, and the main bulk of their sort of customers are not from Singapore, but they're actually global customers. So they're trying to have this like a private bank, but more for the mass market, where you can open a bank account globally and you can have like multiple currency inside the bank. So that's all I have for iFast. I'll now hand it over to Darren. Thanks.
Yeah, thanks, Glenn. Yeah, so Ascott released their results last week. Yeah, so for Ascott, the results were in line at 43%. So we call this in line because the second half is always seasonally better for Ascott because of the demand for travel, and the second half of the year is usually better. So for the results specifically, the gross revenue increased 30% because of better operating performance, as well as the contribution from the acquisitions of 14 longer stay assets in FY22 and second quarter 23. They are also affected by high interest expense, and as a result, their DPU, their DPU increased by 19%. However, their RevPAR for the first half increased by 44% from $96 to $138. So for the positives, the second quarter RevPAR grew 20% year on year because of a stronger base as well, so to $149. Yeah, so it's already at 98% of the pre-COVID second quarter 19 levels. And 5 countries like Singapore, Australia, USA, and UK, Japan, they are performing well above their pre-COVID levels. And China and Vietnam, the performance also strengthened. It used to be 68% and about 80% of pre-COVID levels, but the most recent quarter, in the second quarter, increased to 78% and 83% of pre-COVID levels. So right now, Ascott, they're also having a portfolio reconstitution strategy where they managed to divest, or rather they've signed a sale leaseback to divest 4 properties in France for 44.4 euros to a third party. And the price is at a 63% premium to book, and then with an exit yield of about 4%, and they realized a net gain of about 200,000 euros. They're also having AIs. AI is also undergoing at 5 properties, as well as the redevelopment of Somerset Liang Court, which is expected to complete in the second half of 2025. And for Ascott, they have effective capital management. The cost of that remains unchanged at 2.4% quarter on quarter, and they entered into some more interest rate swaps, which increased their fixed rate loans to 80% from 75%. Their gearing marginally improved to 38.6%, and they still have about 13% of debt remaining to be refinanced at the end of the year. So we expect their interest cost to rise marginally after they refinance these loans. And for the outlook, the forward bookings still remain healthy for them. And international travel, we expect it to pick up as the airline capacity increases. And right now, there are a lot of headwinds in the market, so a lot of corporates are kind of cutting their expenses or trimming their budgets. So as all these corporates do that, many are downgrading from luxury accommodation to more cost-effective mid-tier mass market accommodation. And CapitaLand Ascott stand to benefit as the bulk of their portfolio comprises of these properties in the mid-tier segment. So going forward, we forecast a growth in ADRs to moderate as it's already surpassed pre-COVID levels in many countries, many of their markets. And the driver for RevPAR will come from occupancy. So right now, in the most recent quarter, second quarter, the occupancy is at 75%. And this is about 90% of their pre-COVID occupancy, or the normalized occupancy, which is around 85%, which is their historical normalized occupancy. So with that, we downgrade to accumulate from a buy, and we lower our target price slightly to 120, as we lower our DPU estimates by about 4 to 6% for FY23 and 24. And right now, the Ascott is trading at about 5.7% forward dividend yield. So next is FCT, Centrepoint Trust. So this is just a third quarter update, so no financials were given. So for the positives, their retail portfolio remained high at 98.7%. So the dip in occupancy quarter on quarter by about 50 basis points is due to transitionary vacancies at Changi City Point. So Centrepoint, their historical norms were 99%, but it dropped to about, the previous quarter was about 99%, but it dropped to 92.6% because they're repositioning the mall and they're moving tenants in, and there's the transitioning vacancies. So they're moving tenants like a coach in. They want it to be, Centrepoint to be like the outlet mall of the East. That's what they call it. So right now, occupancy at 8 of their malls, excluding Tampines one, which is undergoing AI, the occupancy is at 92.6%, and 6 of the malls are having an occupancy of 98.6% or higher. So these are quite resilient numbers, like 90.7% is quite high. And you only have 4.2% of leases remaining to be renewed for the rest of the financial year. And for the tenant sales and shopper traffic is resilient. It grew 5% and 16% year on year, and is averaging about 16% above pre-COVID levels for tenant sales. And F&B, fashion, accessories, beauty, and electronics sectors are doing well, and supermarkets and healthcare, they are also performing well, but the growth there is slow because of a higher base from the post-pandemic demand. And for the negative, their gearing increased slightly to 40.2%, and the percentage of the debt hedged it decreased from 76% to 63% quarter on quarter. So as they let their hedges run out. So the cost of debt increased slightly to 3.7%. As you can see, the chart on the bottom right, that is the prime retail rents by sub-market since the COVID-19. Yeah, the suburban rents has been increasing steadily quarter on quarter, while the prime rents in Orchard, it kind of dipped slightly until the middle of 2021, and then it started to pick back up. But going forward, because we see the return of shopper traffic towards the Orchard prime rent, so we think that the Orchard area will see higher rental reversions going forward than suburban. So suburban maybe will predict a low single digit, and Orchard rents maybe low to mid single digit rental reversions. So for the outlook for FCT, their tenant sales are now slightly below 16% and at 5-year lows, and this would help them to raise rents. Yeah, so this occupancy cost is basically the rental they pay over the tenant sales. Yeah, and there are inorganic opportunities for FCT are the acquisition of the sponsors pipeline, such as the 24% stake in Next. Right now, they have a 25.5% stake in Next, and the sponsor 24.5%, and they also have a North Point City South Wing in the sponsors pipeline. And just one thing to note is that AEI has commenced at T1 in the second quarter and is expected to complete by the third quarter of 2024. And 90% of the AEI space has been pre-leased. So with that, we maintain our accumulate call with an unchanged target price of $2.35, and the forward dividend yield is 5.6%. And so next is Keppel DC REIT. So for Keppel DC REIT, their results were in line with expectations at about 51% of our forecast. Their gross revenue grew 3.6% due to the contribution from the acquisitions of Guangdong Data Center 2 and the building share of Guangdong Data Center 3, as well as positive reversions and income escalations from the portfolio. It's slightly offset by government incentives from China for their investments in Guangdong. However, they're affected by higher facility expenses such as electricity costs in some of their Singapore co-location assets. And they had some tax savings on the NetCo bonds qualifying as QPDS, but it's offset by higher finance costs. So as a result, their DPU is flat year on year at 5.05 cents. So for the positives, the portfolio occupancy remained high at 98.5% with a portfolio of 8%, and 12.2% of leases will expire in the second half of this year. And on the capital management front, 73% of their debt is fixed. The average cost of debt increased by 50 basis points as they refinance all their loans that's due in 2023. Their gearing improved slightly, and they have substantially hedged all of their foreign source income to June 2024. Well, the negatives for Keppel DC is that they have a final payment of 142 million upon completion of the Guangdong Data Center 3 when it's fully fitted, and it's expected to be in the third quarter 2023. So that is basically now. So probably very soon they will need to start raising funds to pay off this 142 million. And we think that this might be done through a cash call. So they might raise funds in the equity market. And they could do this by combining it with probably some acquisitions that they might have. So they might combine these acquisitions they might raise funds for these acquisitions as well as this final payment, or yeah, something along those lines. So we do see EFR that they need to do an EFR soon. So this might be a near-term overhang to the share price, as we saw recently. There are some equity fundraising that was done in the market, like Ascenders as well as Mapletree Industrial, and that really affected their share price in the near term. Yeah, so for the outlook for Keppel DC, it's still a secular growth, hyperscale expansion, and generative AI apps such as ChatGPT and Bard continue to accelerate demand for data centers. And Keppel DC is also on the lookout for acquisitions as well as off-market transactions across Asia and Europe mainly. And the sponsor Keppel still has about 2 billion worth of DC assets that are under development and management that Keppel DC could acquire from them. So with that, we downgrade from accumulate to a neutral with an unchanged target price of $2.26 because mainly from the recent share price performance. And the current share price implies a forward dividend yield of about 4.5 or 4.4 or 4.5%. Yeah, so the next couple of slides are actually Meow Meow slides, but she is in another meeting, so I'll have to cover for her. So this is a Keppel Phillip on the ground for Keppel REIT. The next two slides we do not cover. So Keppel REIT is a corporate REIT in Singapore, Australia, and South Korea and Japan. So for their first half results, their MPI increased 4.7%, but their DPU decreased 2.4% year on year. Actually, their as you can see, their DPU actually dropped by more than this 2.4% because it actually dropped by 10.5%. You can see on the chart in the results on the right, that picture. But they topped it up with the anniversary distribution. So after they topped it up with the anniversary distribution, then the DPU it kind of decreased slightly lesser than at 10.5%. Yeah, so for them, the portfolio occupancy is at 94.9%, and we have been 97% if we exclude Blue and William, which is commercial property in Australia, which got its practical completion at April 2023 this year. So right now, that Blue and William asset is about 37% occupied. So their leverage is at 39%, and their borrowing cost is at 2.84%, with 76% of the debt hedged. So for the valuation wise, the Singapore assets were slightly higher, while the overseas assets like Australia, it decreased because of a weaker leasing as well. Australia, there's a lot of supply coming in the office market. So it's slightly weaker for the valuations there. And for the outlook, for the outlook for Keppel REIT, we continue to see demand from new tech and banking sector, and rental reversions in Singapore could still be positive, given the leases expiring in 2023 and 2024 are at 11.55 and 11.06 PSF respectively versus the 12.35 PSF rent it achieved in the first half 2023. But one thing to note is that the office rents for the average CBD rents have still increased quarter on quarter. It was 11.75 in the previous quarter, and the most recent quarter it was increased slightly by 5 cents to 11.80. So it's still increasing, but at a much lower pace as compared to last year. And one more thing to know about Keppel REIT is that the sponsor Keppel will be issuing some of the Keppel REIT shares that are kind of divesting a bit of their portion. I'll let Peggy talk about that a bit more in her Keppel slides, but this will be kind of a near-term headwind to Keppel REIT. And next is a Far East Hospitality Trust. And for Far East Hospitality Trust, it's a market cap 1.3 B. It's basically a hospitality REIT in Singapore, pure play Singapore, and with 9 hotels and 3 service residences. So as we all know, there are hotel RevPAR. I mean, as well as in the whole industry, the hotel RevPAR grew by quite a lot, like 6.9% year on year, with good demand from corporate groups as well as further recovery from the leisure. So the RevPAR has already surpassed pre-COVID levels by about 6%. And one thing to note is that they have, during COVID, they had a lot of government contracts that the government that they had with the government for all the COVID the storing, or rather, I forgot the term that they use, like to keep the COVID patients there, isolation rather, yeah. So for isolation purposes, but right now they've already given back most of it, and only one more is remaining for under this government contract. And the hotel and SR segments achieve higher gross revenue compared to the first half, and the service residences RevPAR increased by 22.8% to $224. Yeah, so this is an all-time high since the trust IPO. And despite the disposal of Central Square, their revenue from the commercial spaces as well as retail grew 11% year-on-year to 8 million, as there was higher occupancy. And for the outlook for FEHD, the passenger traffic, SIA Group's passenger traffic has still been improving month-on-month, and is still not yet recovered to pre-COVID levels, and is at 82% currently. And right now in Singapore, going forward, especially next in the coming soon, there is the F1, and next year there's also a big event such as Taylor Swift and Coldplay. All these will really just benefit FEHD because they are 100% of their assets are in Singapore. So we believe that the occupancy rate and the RevPAR will continue trending up. Yeah, so that's all for me. I'll now hand over the time to Peggy, talk about SIA.
Thank you, Darren. Thank you. Singapore Airlines released the results last week. Okay, we maintain a reduced call, target price the same at 680. Go straight into the results. It's a record quarter. Also seasonally, first quarter is always the best quarter for an airline, for them, and also the third quarter. But now considering that China and the Asian economies have not been recovering as fast, so third quarter demand outlook is could be weaker than historical. Okay, so this is record quarter net profit, driven mainly by passenger. Cargo still continue to be weak, and the very high passenger load factors, 88.9%, also help to drive up the overall revenue per available kilometers. Was up 3.2% for passenger. 88.9% is also a very high number when the upside looks limited for passenger load factor. The airlines is still sticking to their forecast of bringing back capacity to 90% of pre-COVID level by the end of March 2024, mainly because this lack of aircraft. They retired 47 aircraft during the COVID now, so they can actually bring it back to up to 100% capacity. So we see the load factors, passenger load factors, could have hit the peak. Deeper dive into the results, you can see that the biggest tailwind is the fuel price. The average fuel price for them was down 30%. So therefore, in terms of net fuel expenses, if you refer to the table on the right, they had a 200 million gain from there, 220 million gain from there. That almost account for more than the improvement in operating profit. Right? Fuel expenses, going by common sense, when the capacity increased, fuel expenses should go up. But this is a decline because of the average price reduction decline. Last year there was the eruption of the war that caused the surge in price. The other thing is that helped them was that they had a fuel hedging gain in this first quarter of about 100 million. And other things are like higher interest as income, because there was a lot of forward bookings, so they collected fares in ahead, and they were able to enjoy interest income from those advance payment. And Vistara, made a profit, beats my expectation. Most of that profit came from a 60 million forex gain because rupee was stronger in Singapore dollar during this period. And cargo continued to be a drag. It's a result of both weak demand and capacity build up. Management does not think that there will be a Christmas boom coming this time round for the cargo volume. We still feel that the a concern that the competing carriers reinstating capacity will actually crowd the outlook over use and load demand. Even everything's status quo. Typically, when there's a recovery in airline business, they will put in those. They will add capacity on those routes that are higher yielding first, the more favorable routes. So as they continue to keep adding more routes, the one that they add will obviously be lower yielding. So in that sense, could see already yield should be trending downwards. Average yield, I mean. So then now that with your other competing Asian carriers also adding capacity, like Cathay Pacific is running another round of promotion again. So we see weaknesses in potential weakness coming through in terms of yield and load. So India call reduced at 680. That's based on 1.1 times FY24 price to book. Moving on to Keppel. Keppel Corp had the results and the briefing on Thursday evening. Most of the jump in the earnings is flat. Net profit is actually only up 2.5% from continued operations, and this half they benefited a lot from the higher energy sales and energy margin. In the month of May and June, the USEC Uniform Singapore Energy Price actually surged, and they benefited from a surge in margin, but the management feels that things that they are able to maintain this margin going forward. So believe that infrastructure, which contains the energy business, will continue to be doing the heavy lifting going for the rest of this year. Another so-called good news for investors, good news in inverted commas, is that a distribution in specie of K-REIT shares. For every 5 Keppel Corp shares, they will give 1 K-REIT. They will distribute 1 existing K-REIT shares, which they are holding to Keppel Corp investors. That's if you based on K-REIT price of about 90 cents per share, that works out to be about 18 cents per Keppel Corp share as a special dividend to Keppel Corp shareholders. The 2 things to note here, because the K-REIT is actually held in the books at a discount. The book value of K-REIT in Keppel Corp is actually higher than the current share price. So there will be a one-off reduction in their equity, and plus they also will lose a 9% share in K-REIT. After this distribution, the stake will drop from 47% stake to 37% in K-REIT. So there is also another loss of income. So another rationale for disputing this is, okay, there are 2. One is their promise of asset monetization. This one is counted as one. The second thing is their stake in K-REIT at 47% is actually a very near borderline of 50. If it crossed 50%, then they will have to console K-REIT's debt. So they just want to prevent that. So this is one step for them to do that. And if they were to sell the K-REIT shares in the market, they probably have to sell it at a discount to the market price. So this is probably the best way for their balance sheet. Okay, the real estate division, as the first quarter was still quite robust, but second quarter turns very challenging, especially in China. So they recorded lower development profit and fair value gain this year. And this real estate also faced with higher interest expense. Most of the land bank in this real estate segment is mainly in China and Vietnam. So China is not recovering yet. Vietnam is still undergoing, still trying to pick up from last year's the crackdown on the banking sector. So if we see any improvement in these 2 countries, then there will be a potential higher revision in my earnings forecast. Currently, at the halfway mark of 445 million net profit. This is about 50% of my full year forecast. And also the net gearing has risen to 0.86 times, mainly because when they dispose of Keppel Offshore Marine, they also gave about 432 million cash out to Seatrium. Because Keppel, KOM has about 930 million cash in its balance sheet, and then they have to return 500 million back to Keppel Corp. So all in, Keppel Corp have to give up 432 million cash to Seatrium. So we upgrade our target price to $7.70. Previously it was $7.01. This is because if you we look at the recent contracts that they have been able to garner. Those are very sizable, very leading edge technology projects, like the Keppel Sacra cogen plant, which is the first hydrogen ready and the most efficient power plant Singapore is going to build. And then they also are importing clean hydrogen and ammonia production electricity from Australia, and these will be exported to Asia with partners. They're also importing renewable energy from Cambodia and Laos. So all these projects will actually strengthen the foothold in the Singapore energy market, where our reserve margin is actually reducing, and EMA is taking a lot of effort to try to make sure that we have enough power capacity from at least from 2025 onwards. So therefore, anyone who has been able to get in, bid and win these contracts, actually get a stronger foothold in the Singapore energy market. It's like putting, a better word, putting a tissue paper on a hawker center before you go and buy a food. Your seats is already secure. Yeah. So therefore, our target price of 770 to factor in the higher share of earnings from energy from FY25 onwards. Thank you. I'll move on to Phillip on the ground for Hutchison. Okay. Attended the analyst briefing for Hutchison. There's a very weak set of numbers. Net profit was down 75%, half and half. Hutchison, if you recall, they have two main and they have two locations for container ports. One is in Hong Kong, one is in Yantian, Shenzhen. Yantian, they own 56%. Then they have all other ancillary facilities and services that they provide. The revenue was down 20%. There's very weak cargo volume out from Hong Kong to US and Europe. China, the decline is less, but they still see a decline in volume nevertheless. The exports to US, according to management, it's not likely to recover in the third quarter. Probably the recovery will probably push out to fourth quarter. But for AU, the decline has kind of weakened. For the first 4 months of this year, was down 11%. By June, it's come down to a single-digit decline. So and partly also because EU was first to slow down. So now the slowdown has stabilized. Another thing about Hutchison is that they cut the dividend. Last year, first half, they were paying 6.5 cents. This year, they only announced 5.5. They had a prior full year dividend guidance of 14.5 cents for the full year, which will yield 10.1%. But when I asked them if they are able to keep this guidance, they say they are not certain. Okay, so maybe not to be too hopeful. Okay. Another thing is when we look closer at the cash flow, they paid out significant dividend in last year and first half of this year to the minority shareholders. The minority shareholders that at Yantian, because they own 56%, right? So they will have to the amount they paid to minority shareholders. We can spot it from the cash flow. Two things I read from here. One is maybe they want to maximize the loan at Yantian to benefit from a lower cost interest in China. Or the other thing is that the minority shareholders just want the cash out. So whatever the case, it's actually just lower the cash level at Hutchison and over the equity at Hutchison. So in not very optimistic for dividend for the dividend outlook. Okay. Okay, let me try. Okay, sorry, I speak louder again. Okay, so the management, one thing that management observed, which we think would be noteworthy, is that they noted a lot of positioning of empty containers at the Chinese ports. That means during the COVID time, a lot of empty containers, because of port congestion, were parking at all the various ports. They now are all being gathering and moving to China. This is a sign that suggests possible pickup from China exports. We spoke to Westport. They also saying they see the same. In the past, this time of the year, usually 20% of the container goes in that direction to China. But right now they see about 30%. So there's a higher pickup in the containers, empty containers going to China. So it's usually empty containers going to China to pick up cargoes and they send out to the Western countries. So there's something to be optimistic about in terms of the output from the China market. Yeah, that's all for me for Hutchison. I'll move on to Seatrium. Okay. Seatrium also affiliate on the ground because I have not comments coverage. I really tried very hard. I can't turn positive. I can't bring myself to turn positive on the stock. Okay. Let me just go down to the results. The first half they make a net loss. Actually, it should be a net loss. The typo, right? 264 million. That's about the same as last year. The whole of last year. Actually, from second half of 22, we thought there would be a slight improvement, but it seems to not be the case. But EBITDA turned positive. We also the number is too small for us to be excited about. The gross loss of 150 million. It included a provision of 231 million. They made for they call it contract and merger expenses. When we ask further, it's actually the cost was mainly due to the US yards, the operations US yards, where they face higher labor costs and higher materials costs. So, and there are two big projects working down there. If hopefully there's no delay on those projects, otherwise there'll be a lot of more repercussion. The management is still doing their strategic review after the merger with Keppel Corp, Keppel O&M. They say it will still decision will also be made only year end. They have nothing to tell us. As may ask whether there will be more provisions to be made. They also cannot confirm. They issued 36.8 billion new shares to for the acquisition of KOM. So therefore, the shareholders' funds has been raised to 8.3 billion at the end of June 2023, and that helps to lower their gearing to 0.17 times. But if net debt has actually run up to 1.4 billion as at end of June. They also in the balance sheet had 1.1 billion of contract liabilities. This effectively means advance payment from customers. So that means the cash does not belong to them. So all in, they will need, and they also had a negative net working capital in the first half of this year. So all in, we think that they will need to seek refinancing for about 2.4 billion in the near term, because the bulk of this is our loans that has been reclassified to short term. So that has to be refinanced within the next 12 months. Okay. Management spoke a lot about cash flow neutral, cash flow positive contracts, because when we asked about whether there's a slowdown in their order take, a the new orders secured in the first half of 4.3 billion. Part of it was secured in the first quarter. Second quarter was very minimal. So they say they are fairly selective in participating in jobs because they want to find contracts that are cash flow neutral or positive. When we asked them how would they benefit from the increase in the drilling activities and the higher utilization rate for all this equipment involved in these drilling activities, they say they will be very selective in participation. This is a bit disappointing when we heard that, because drill ships, the utilization has actually hit about 97%, and even for B class vessels is now trending at 83%. So there's a lot of high demand and also lack of supply in the market. And if the interest rates will pause or go head downwards, then equipment makers will be the operators might be more eager, will be in a better capacity to place new orders, but Seatrium's balance sheet might not be strong enough to take them on. Yeah. So that's all from me. I hand over to Zane for the technicals. Thank you.
Thanks, Peggy. I'll move on to the technicals. So looking at S&P 500 last week, we didn't really move much. So we were mostly sideways between 4,530 to about 4,006 area. So I think for this week, we could still continue in this range, given that we are quite at the top end of the two uptrend channel resistances. So for this week, we could expect some resistance at 4,580 to about 4,630, while support is likely to be between 4,460 to about 4,530 area. Next slide. For individual counters, we have Hutchison Corporation. So for this, we have a technical buy at 14.1 cents. The take profit level is at 17 cents. Stop loss at 13.4 cents, and the stop loss goes at 13.9 cents on Friday. So for Hutchison, there looks to be a potential bullish cup and handle formation breakup that took place last Thursday. And another bullish sign is that the stock has been making higher lows into the resistance at 14.2 cents with the respect of the uptrend support line. And MACD also looking bullish as well. So in terms of the projection wise, if you take the height of the cup, which is around 3.4 cents in projected to the breakout point at around the 13.6 cents level, I think we could possibly hit the take profit level at 17 cents. Yeah. So that's all from me now. I'll pass back the time to Peggy to talk about Singapore Weekly. Thank you.
Thanks, Zane. Yeah, Paul is away on the brainstorming is like Phillip equivalent of G20, so he has to be there. So I'll run through his slides. Basically this week, last week rather, we saw RevPAR for in the Singapore market still strong at 18% year-on-year for the month of June. Slight slowdown from May, and that is still 22% above pre-COVID. The industrial production, however, is a very weak set of numbers. June was down 4.8% year-on-year. Electronics down 3.5%. Slightly smaller than May, but still last year June was already a weak June. So there's some sign of improvement, but still contracting on the 3-month moving average basis. The residential property, for the first time, we see second quarter price fall by 0.2% quarter on quarter, after a 3.3% increase in first quarter. This is the first decline since first quarter 2020 when COVID hit. Volume was also down 11%. This will affect the property agency business. So all the metrics are cooling down. In terms of the interest front, all the central banks are have raised interest rates. Fed 25%, ECB did the same. Japan technically also raised the rates because they allow the 10-year bond yield to rise above 0.5%. But the forward decision will be very mainly data driven, data dependent. But ECB seems like more willing to pause than the Fed. Okay. And in terms of the data, the economic data, in US, new orders, durable goods up 11% year-on-year in June. There's a rebound in corporate capital spending. And core PCE, this is the number that the Fed usually tracks. In June, it's up 4.1%, a slight improvement from May, 4.6%, and still the slowest in 25 months. And month-on-month is the slowest in 31 months. Hi there, can you move the slide, please? Okay, so our tactical views is that we think the potential decision on interest rates, whether pause, if they will, the pause will be good for asset prices. There is a more evident signs of inflation coming through, especially we had a very high base effect in fourth quarter last year. Okay, so we think it will be a driver for asset prices. Okay. So going in the week ahead, we have results from DBS, Amazon on the this week, and also Sembcorp Industry on Friday, and Singapore retail sales and OCBC on Friday as well. Then these are the webinars that we will be hosting. Please join us if you have questions for the if you want to listen directly from the management. I just go through some of the slides. Yeah. So this is why we say residential property is cooling down. In terms of the inventory level, there's a climb back up to it's climbed up again. Please look at the light blue bar on the left chart. So it has crossed the average of 2.6 years for in terms of unsold unit inventory to sales to the yeah. Okay, and then in terms of volume, in terms of the resale volume, the orange bar is actually is really went back to the 2019 level. In 2019, we had the cooling measures in June that year. So annualized wise is probably back to 2019 level. Next chart, please. Okay, then in terms of rental, index has risen across all the industries. In the Singapore context, most of the rental, the lease are signed for 3 years. So last 3 years ago, this time during COVID, most of the rental were probably signed at a low level. So this increase is also not a surprise. And then, but in terms of pipeline wise, retail has very little pipeline going forward, but office is coming. Return is coming back by 2024. Okay. Next slide, please. Okay, so this is the US core PCE inflation. It's dipping downwards, 3.7%. Still some ahead of the target of Fed's target of 2%, but at least the direction is what they like to see. Yeah. Thanks very much. I think that's the last slide. Yeah, and so. We finished with the presentation. We can go to the Q&A now. Thank you.
Yeah. Thanks, Peggy. I'll start the questions. Hi Darren, what does ADR stand for in your presentation? So sorry about that. Sometimes if I forget to explain what it means, yeah, thanks for letting me know. Yeah, ADR, it means average daily rate. So it's average daily rate times the occupancy to get your RevPAR. Yeah, so that answers that. And then the next question is, hi, is FEHT a better buy than class, as FEHT's portfolio is 100% Singapore in the target segment mid-tier, which is more like in line with market demand? Would FEHT be a top pick in hospitality? Yeah, so sorry about that. We do not cover FEHT, but for the hospitality sector, we like class, and class is our topic because of its, first of all, its geographical diversification, and it has a good mix of stable income sources in times where the market is not so good, like their longer stay accommodation, like the PBSAs, the purpose-built student accommodation, as well as the SRs. And yeah, so for that class has about 15 to 20% of the revenues from Singapore. Well, FEHG is 100%, but if you are trying to play the strong tourist arrivals to Singapore, especially like for the big concerts and F1, FEHG will be a better play because will be a better buy because it's 100% of the assets in Singapore, and they are full beneficiary of all these big events that are coming in Singapore in the coming few quarters. Yes, so yeah, so we do not cover FEHG. Yeah. Yeah, Keppel REIT, may I clarify, is the anniversary distribution like a capital distribution and funds are from within Keppel REIT itself? Yeah, that's correct. So the funds is not from their operations. So based on the slide just now, if you just look at operations, the DPU is down 10%, but because they topped up from within Keppel REIT itself, which is a non-operating, then yeah, as a result, their DPU is down less. Yeah, but it's from within Keppel REIT itself. That's correct. Yeah, I think that's all for me for now. I hand over to Glenn. I think you want some UOB questions. Yeah, thanks.
Yeah, thanks, Darren. Yeah, so for UOB, I think it's one. Sorry, there be quite a few questions. Let me try to find it. Okay. What does the future dividend outlook for UOB look like? So UOB has said that they are going to stick with their 50% dividend payout ratio. So unlike their peers, I mean, they're not going to, they rather not increase it beyond 50%. So it's going to look like it's going to be around 50%. So based on that, and our forecast, we would expect that their year-end dividend or DPS will be around 175. So now it's 85. So it's a possibility that the year-end will the fourth quarter or the second half dividend will look to be around 90 cents. Yeah. One more question. Let me see. Given the UOB results, what is your take on the forthcoming DBS and OCBC results? Will it be the same weakness on non-interest income and credit costs? Okay, so my take on the next two local banks, I think it would be mainly the similar things where we see the net interest income still showing very strong year-on-year growth. However, we will of course see a stagnation in the NIM's growth quarter-on-quarter. For sure, but year-on-year, I think we will still have at least a double-digit increase in basis points increase for the net interest income. Yeah, and I think when you say non-interest income, I think you meant fee income because there are other non-interest income which showed very strong growth. So I think it should be similar for the fee income where there might be a slight drop-off due to the overall market sentiment. And even with UOB, like I didn't mention this earlier, but they had the sort of boost from the Taylor Swift concert tickets, where they had the priority. If you had a UOB card, you could sign up earlier and had a chance to sort of get tickets earlier for Taylor Swift. So they did have a small boost from that. And however, they mentioned that that actually the boost overall is not very significant because it is such a short time frame for them, and the amount of cards that they got in were mostly debit cards, so not credit cards. So it didn't really add much to their fee income, and mostly it would be trying to retain their new users and not so much trying to get this big jump from the sales in the what do you call it, in the tickets for Taylor Swift tickets. So I guess the other two banks will be quite similar in that aspect. However, credit costs, I think UOB is slightly different because they had that major corporate account in Thailand due to fraud where they had to fully provide for. Hence, the increase in their specific allowances, which rose, their credit costs also rose quite significantly, I think by around 5 basis points to 30 basis points now. So I think if the other two banks don't have a similar scenario, so this is quite a specific scenario to UOB. So if the other two banks like DBS and OCBC, they don't have such a large corporate account suddenly they have to fully provide for, I don't think they will see an increase in their credit costs, at least on the base level. So it might go up, 1-2 basis points, but I don't think it will have much of a big difference for them. Yeah, so I think they will definitely show stable credit costs. That definitely, maybe with a bit of an increase due to the high interest rate environment, but I don't think it will be as similar to UOB. Okay, I think that's all for me for the banks. I'll hand it over to the rest of my colleagues. Thanks.
Thanks, Glenn. I'll take over. Okay, there's a few questions on Keppel. Let me do those. Okay, no, so sorry, SIA, I think. Let me start with this one. Hi, Peggy. If demand growth skews towards lower yield routes and Scoot, do you mean growth comes from low margin route, or is it more passengers are filling up economy class and budget airlines, which gives lower margin than business class? Thanks. Okay, in the airline terms, when we say yield, it's just really revenue. That means so it's lower yield routes means it costs less per kilometers, per seat kilometers. So the answer is the second part. That means the more demand for economy and for the budget airlines, like for instance, Scoot has very, very high load factors and exceeded 90%. Almost getting people sitting on top of each other. No, so with low yield doesn't really mean low margin, because we also have to measure the unit cost, and unit cost has been rising, of course. Yeah, so it's because more filling up economy and the lower price fares, and SIA also said that the corporate travels has been very, very slow in picking up, even post-COVID. So most of the travel demand is actually from revenge travel, which up to a point that will go off. Yeah, thanks. The second question is, please comment on why the price on sets keeps moving up. What is the upcoming catalyst? I think the optimism for sets came from the fact that the opening up of China and our 15-day visa-free travel for Singaporeans out to China. SATS has 3 kitchens in China, which were Tianjin, Nanjing, and another place. Yeah, which will benefit for more flights coming out from China, in and out of China, to these airports, and more ground handling and more food being provided from these central kitchens. Okay. But otherwise, we are waiting apprehensively for the results, which will show how much would WFS account for their balance sheet, and what's the impact of the higher cargo or lower cargo demand on the enlarged portfolio. Yeah. Thank you. Okay. Sembcorp post dropping disposal of its waste unit. What is the target price with this news factor in? I have a target price of $5.06. I have not factored in this disposal at all. I argue that it's very difficult to find somebody to buy this, because you have some criteria to fulfill. Besides track record, you must be in Singapore for how many years, you must be covering how many households in the past, and so on. So very few has that track record. Maybe one who can do this is maybe 800 Super, which is owned by Keppel, but Keppel is in this asset monetization exercise right now. They wouldn't want to buy anything that will load up their balance sheet. So therefore, I did not factor this disposal into my earnings, my target price. Thank you. Hi Peggy. Does Keppel Corp has pricing power for the infrastructure business? Are the prices of infrastructure business government regulated? Hence, revenue margin upside is capped. Thanks. Yes. The government is very highly regulated and monitored, and also because power is a key business cost to our manufacturing, our business activities. But having said that, we also have foreign players. The biggest power energy players for the Singapore market is actually YTL and the Japanese, another consortium by the Japanese. So there also need to be some kind of incentive for them to turn on the switches. So therefore, the margin upside, I think, is capped. Yeah, but a lot of most of that upside will have to depend on how well what they procure their gas supply, the supply of the feedstocks. So if they can manage to buy something cheap, then they can widen the margin on its own. So that's how good the management is. Yeah, thanks. Keppel Corp, did the distribution of K-REIT as dividend result in Keppel Corp recognizing a loss? How much is the loss? Can you repeat what you say on the book carrying cost of K-REIT? Okay, when they distribute 9.4% stake in K-REIT, the pro forma loss is about 135 million Sing dollars. A lot of the bulk of it is because of the carrying cost in their books being higher than the current share price of K-REIT. Only about out of the 135, I think only about 42 million is because they lost this 9.4% share of K-REIT's profit. So the book value, I estimate the carrying cost in the books is about $1.15 per K-REIT shares. Thank you. Seatrium, how much debt classified short-term needs to be refinanced? I'm concerned about the higher interest cost on refinancing. Estimate about 2.4 billion has to be refinanced. That is classified as short-term. Yeah, 2.4 billion Sing dollars. Hi Peggy, how does Keppel's EAAS scheme works? Is it profitable and a good business model? Thanks. Okay, they are launching EAS in Singapore. They also have it in Vietnam and Thailand. Okay, in Singapore, they are a power producer, so the scheme works differently from those overseas. Right? So in Singapore, they will install the panel on say Sabana REIT rooftop. It will be out of Keppel's balance sheet, and then the Sabana REIT will pay for the energy usage. It's a fixed term, a fixed price and a fixed value. But yeah, but Keppel is able to sell this solution because Keppel believes that they have a very efficient cooling system. So they're actually able to manage to lower the cost of the power for the user as well as for their own power generation operation. So therefore, Keppel thinks that this will add on to their own to its power generation EBITDA and margin. So in Singapore, this is how it works. In the overseas market, they operate like the telco. There's this thing called MVNO because they don't have power generation assets overseas. So they'll just buy power, or they sell the power from the solar panel to the grid, and the grid will then sell it to the user, or sometimes it's directly to the user depending if they sign the contract directly, say maybe industrial parks. So they become like they take in between, so the arbitrage between their cost and the price that the value that the value of the energy that they generate. So over time, the Singapore model is probably going to once it gains a sizable size in terms of the balance sheet, like maybe 300 to 500 million, they will then package these assets, these solar panel assets, and put into a REIT or find some co-investors in there. So also also the definition of asset monetization. So over and then of course at that time they will probably sell it at a, when it has stabilized, they sell it at a book value. So therefore there is two bites of the cherry here. One is from operating income and another in future from fee income from this business. So it's a very long-term trend. It will only happen it become a meaningful size only in 12 to 15 months time. I hope I answered the question. If I confuse you, please let me know. I'll try again. Thanks. Okay, I don't know, not sure whether this should be answered by me or Darren. Is K-REIT worth holding for Keppel Corp shareholders, getting it through in-specie dividends? I don't think so. Because I just pretend myself as a Keppel Corp shareholders. Once I receive K-REIT shares, I don't know, I think to me, because it's considered as a dividend, and if I buy Keppel Corp for energy business, for renewable, for ESG purpose, then if I give you K-REIT shares, I probably will want to dispose of it to recognize my dividend gain. So we think there should be some weakness in K-REIT share price because of this, or nearer to it when after the EGM, when it's confirmed that it will happen. Thanks. Okay. Hi Peggy, SQ, what is the outlook on the partnership with Air India? How does fuel hedging work? If you manage to attend SQ's AGM, what are some of your impressions? Thanks. Unfortunately, I couldn't attend SQ AGM because I was with I have another presentation to attend. Yeah, but anyway, the partnership with Air India is not undergoing antitrust scrutiny. If Vistara is able to merge with Air India, SingTel SIA is committed to invest up to 800 million Sing dollars to bring up its stake to 25%, and also for this joint venture, this merged entity to be able to grow from there. So I'm not very sure how to look at this because I'm not familiar with India. But from the past, when I look at Air India, I don't recall them making a profit ever. So I really need to think about how they're going to change the business model for them. Yeah, because in India, the domestic market is very protected. SingTel, SIA has to, if they want to get into the Indian market, this is probably the only way to do it. But otherwise, they will not be able to get into the India routes. And even for SQ flights to fly into India, that's a G2G arrangement. So I think strategically there's a reason for them to do this. But financial wise, I'm not sure whether it's good for Singapore Airlines. Okay. The fuel hedging works is that how it's fuel hedging. SQ typically will hedge about 60% of their fuel requirement for the next 6 to 12 months. So they'll buy ahead, right? So this fuel hedge, the hedge that they just get expired and they book 100 million gain, is a hedge that they entered into 12 months ago, where fuel price was low at that time, was lower, so they could manage to secure their average fuel cost at about $90. Right? But right now the price has gone up to, I mean, when they closed the quarter, it's gone up to 120, above 120. So therefore they book a gain on this. Yeah. But otherwise, it's actually they just buy whatever they need, or up to 60% of what they need. Yeah. So they don't speculate on the fuel price. Okay. Thank you. Yeah. Next one. Is it better to buy Keppel Corp and enjoy the entitlement to KDC distribution, or to buy KDC directly? Oh no, this is not KDC. They disputing K-REIT. So not KDC. So I think, well, if you like K-REIT, you should just buy K-REIT directly. No need to go through this whole cumbersome way of buying Keppel Corp shares. But Keppel Corp, if you like Keppel Corp on its own because of the energy and the renewable and the higher weighting that they probably can get from ESG investors, then Keppel Corp is a buy. And we have raised our target price because of this to 770. Okay. Darren, can I pass to you to take over for a short while?
Yeah, sure.
Yes.
I'll answer some questions. Then I'll hand it to Zain. Yeah, there was one question on the Keppel DC REIT. So I missed that. That was quite early question. Hi, with a final payment of 142 million for Quantum DC to be financed via debt since gearing is low at 36.3%. Yeah, so we do some calculations. If they finance the payment of 142 via debt, then their gearing would rise to almost 45% already. So that's not what Keppel DC would want. So they would like to keep their gearing around below 40. So below 40 is like a good range for most of the REITs. They like to keep their gearing around there. So if you bring your gearing up to 45, then a lot of investors will start to panic, like, oh, it's going to hit the limit and whatnot. So yeah, I think it's unlikely that they will do that because they want to keep their gearing at a low instead of raising it to almost 45%. Why is Keppel DC REIT price not reflecting the AI buzz? Yeah, so Keppel DC REIT is not a direct beneficiary. It's more like an indirect beneficiary to the AI buzz because, like, you look at the big tech, those are like kind of direct beneficiaries. But Keppel DC REIT, they'll benefit like if the AI companies, the big AI companies, they start investing more into this demand for data centers and more higher GPUs requirement, more power, and more data center needs. So this is more like an indirect beneficiary. So as of now, Keppel DC, they indicated that they do know that it's a circular trend that they will benefit from this going forward, but they have not really seen much of these AI companies requesting this so-called demand for these DCs for AI purposes as of yet. So it's still quite nascent. It's still slow. Yeah, it's more like an indirect beneficiary. Yeah, but we do know that Keppel DC, the price did increase quite a bit, like 10% in the near term recently. I
do the property question.
Oh, okay.
Yeah. For the property sector, is the decrease in URA index due to demand or supply driven factors, i.e. more new launch at higher PSF would push up the URA index? Thanks. Yes, I think and the decline in the index is actually sorry, I don't elaborate just now. It's actually mainly also because of the demand factor. It's actually more because of the demand factor. Sorry, balik. Okay, the demand is softening mainly because buyers are seeing that there's a lot of supply coming out in the market. Right, the GLS Singapore Government Land Sales Program this year is going to be a record, bring in a record 9,500 units of new launches. So it's more than 50% higher than last year. So there's expectation of more launches coming up. Some are positioning for better locations. Some are hoping for better prices, for lower prices. So the demand is held back right now. So we think the softening in the URA index is actually more because of the it's the demand. The buyers are having a stronger bargaining power now. Of course, if you have more new launches, a higher PSF will push up the URA index. So therefore, when the URA index decline, it's actually even double bad news, right? Because you know that new launches are higher PSF and still it drops it. Then the property sector is really in a cooling off mood right now. Yeah, thanks very much.
Yeah, thanks, Peggy. I think I'll take some quick one. Like there's one just that says Suntech REIT. So I'm not sure whether it's a TA or FA question. Yeah, just do a quick one. The FA. Yeah. So at Suntech REIT, they had a low hedging ratio, so they are really affected. The DPU was affected quite a bit this quarter, and it was down. I can't remember, but it's a double digit down. It's quite a big decline. They also divested some strata assets in Suntech. So that also helped to bring the gearing down, but overall the performance was not too great. Yeah. Then for so Manulife and Prime, there's a TA/fundamental question. Yeah, so Manulife and Prime, they release their results in 2 weeks' time. Yeah, so the most recent update is for Manulife is property valuation. Like it declined so much that they hit the 60.2% of the covenants of unencumbered loans to unencumbered assets. So that is they are seeking a waiver from the banks. So in the meantime, if they manage to get the waiver, then they might be able to declare some distribution. But if they don't, then it's unlikely they can do so. So so Manulife is facing some issues, unfortunately, right now. And for Prime, they are not affected that much by the valuation, so they did not do they spoke to their valuers. They are not impacted by more than 5%. So usually more than 5%, if their property value decline, then they will do a mid-year valuation. It's for audit purposes, but since it's the asset valuation did not decline more than 5%, they didn't do it. So they are not facing as bad an issue as Manulife, but right now their gearing is about 43.7% for Prime, and the property value needs to decline by more than 17% before it hits the 50% gearing limit. So for Prime, there's still some leeway, but yeah, the property value didn't decline the mid-year by Manulife's level. I think that's one more. Hi, Darren. A REIT's DPU always has 3 components: taxable, tax-exempt, capital distribution. May I know how these numbers are derived and the respective source? Yeah, so basically, for the taxable dividends is income that's a distribution from the REIT that's derived by individuals through a partnership in Singapore or from the carrying on of a trade, business, or profession in REITs. So this is quite technical. And then for the non-taxable portion is any income that is distribution that is from the REITs, except distributions which is taxable, which is derived by individuals through a partnership in Singapore or from the carrying on of a trade, business, or profession in REITs. Yeah, then the last one, the capital distribution, that one is not taxable. So yeah, I hope that answers the question. Yeah, it's already 12:40, so I'll hand out the time to Zane to do some.
Wait, sorry, Darren, just one more last Keppel question.
Sure.
I think I don't know how come it jumped to the top now. Okay, Peggy, thank you for the good explanation on Keppel. You mentioned about renewable energy business in Keppel. Wouldn't Keppel Infrastructure Trust be a better option than Keppel? If we are focused on the renewable energy business? Basically how it works is that Keppel Corp and KIT, the relationship is Keppel Corp will give the tolling business to KIT. But Keppel Corp, what Keppel Corp has is Keppel Corp will keep the asset. It's still the owner of the asset. This is, for instance, the Keppel Merlimau, which KIT stopped collecting disputable income from, right? The Keppel Merlimau, the power plant, is still owned by Keppel Corp. So when they pass the 51% stake to Keppel Merlimau, effectively Keppel Corp still earn the fee income from KIT, right? And then for anyone who wants to buy carbon credit or who needs to because maybe they are in fossil fuel, they need to buy something green to be less sinful. The one who sells this credit to them is Keppel Corp and not KIT. So therefore, Keppel Corp has a bigger say in terms of in the whole value chain, right? The KIT is more further down the food chain. Keppel Corp is further up the food chain. So when the assets mature, Keppel Corp when then choose to sell it to a KIT. KIT is like a fund, right? Then invite third-party investors to participate in. So it's more like using third parties' money, other people's money to pay up to reduce your balance sheet. So Keppel Corp is better business model than a KIT model. Yeah, especially for the renewable energy in the energy segment where very high capex is involved. I hope I explained that well. Yeah, thanks. I think I will maybe I pass to Zane for technicals first while I see if there's any other coming through. Thanks, Zane.
Thanks, Peggy. Move on to technicals. Let me just share my screen right now. Okay, yeah. I'll just start with the Keppel Corp. I'll go on in chronological order. So for Keppel Corp, looking good after the results. We had a retest of the recent swing high over here, and then our price actually pushed higher over here today. So I think we could still trade higher if we do go on to test this trend line over here. That would bring us to maybe a price could be test about around the 760 level over here for Keppel. So still trending very well. And next one is XPeng. XPeng has seen a very massive rise in terms of the share price. I think currently we could encounter some form of resistance at $96, $97. Given that it was a previous swing high over here back in August last year, and then you can see price has actually just shot up in 90-degree manner. So I think I'm leaning more towards a little bit of a pullback or consolidation for XPeng right now. Some support will probably come in at the previous support level around 77 to about around $82 over here. If you do retest, I think we could find some support over there. Then next one is the Agricultural Bank of China. So I think for Agricultural Bank of China, I think currently we are still consolidating a bit of a downtrend trend over here. But recently, the price action has been quite good. Last week wise, we actually broke above this range and actually tested this 275 previous support and resistance. And today we actually went up further. So I think we can, if we can continue to form a higher low, especially if this 275 acts as a support, I think there's a chance that we could see some sort of breakout over here. Something to watch out for Agricultural Bank of China, where the next resistance likely to come at around 280 to about 290, this region over here. Then next one, I'll talk about OCBC. Okay, OCBC has been very strong. We took out the swing high over here around 1280 and price currently around 1320. So I think a bit similar to Keppel, we could go on to test this trend line over here, which has tested about 3 times in the past. That might bring us to maybe a price of around 1350 if we do continue the bullish momentum for OCBC. And next one for iFast, another one. We actually broke above this uptrend channel over here. So price actually just melted up, and we actually tested this swing high around 575. I think over here we could encounter some resistance given a previous swing high with high volume over here. So we could do a little bit of a consolidation for now. I think support would be around 535 over here at this level for now. And next up is Thai Bev. So Thai Bev, I think price action has been pretty okay recently. We actually, after a very long period of consolidation over here, we broke above 59 cents. And we actually tested these two levels today, which is this downtrend resistance line over here, which is around 61 cents, and also a previous support resistance over here. So you could see some form of price having some form of resistance over here. But for now, current support we do likely is around 59 cents. If we do make a form of retest over here, if we do make a higher low and then subsequently do a breakout, then the next resistance will likely come around 63 cents mark. Next one will be Seatrium. So for Seatrium, we actually tested 13.8 cents level, horizontal level over here, which was also the 20-day moving average over here after the results, and we found some support over here. And currently, price is being resisted by this previous this range over here, previous support. Now we're acting as resistance at around 14.4 cents. So I think if you do hold these two levels, we could be seeing some form of a range trading for now for Seatrium. Next one is Sembcorp Industries. Okay, Sembcorp, I think price is still holding at this trend line over here, this black color trend line. Previous resistance still acting as support upon these few contact points over here. I think we could be consolidating in this bigger wedge over here right now. You can see price action sort of volatility wise actually shrinking. So I think as long as price hold in this wedge, we could look forward to some sort of a breakout or breakdown afterwards. Current support likely be between 535 to about 545 over here. Resistance likely coming around 565 to 570 over here. Next one is some Hong Kong counters. So first up is Alibaba. So Alibaba has actually recently we have touched the uptrend channel, the top end of the uptrend channel over here around $98. I think there could be some form of resistance in near term at this level to about this swing high over here, 101. So I think price could face some resistance over here, where we could see some form of pullback, where the next support will come in around $95 over here. If we do a retest. Yeah. And next one is Meituan. So for Meituan, currently there's also a break of this consolidation over here where the resistance was around 138. Price tested the next resistance level around 147 over here. So if this resistance holds, we could see a little bit of a slight pullback to maybe perhaps retest this previous resistance for some support. If you do hold, then probably the bullish momentum over here can continue if you do form higher lows. Okay, the next one is BYD. So BYD, I think currently is still trading in this uptrend channel over here. Price recently broke above this resistance 267, 268, and also of these two resistance levels previously. So if price is able to hold over here, we could see possibly some further upside to test the next key resistance, which is around 295 in my opinion, which is this channel resistance as well as the previous swing highs back over here. This was in July to August of last year. So still trending pretty nicely for BYD. Next up is Jardines Cycle and Carriage. So Jardines CNC, I think, is still in a form of a consolidation over here. Price is just kept in this range. I think that will probably continue unless we see a break upwards of 34.80 over here or break downwards below $33. Yeah. Then I think if not, it's just continue to range trade for now. Next one is Venture Corp. Okay, Venture currently, I think currently there's a, it broke above this downtrend resistance line last Friday around 1470. But one thing to note that price has been making lower highs into a support. So this key support is around 1450. You can see lower highs being formed. So if that continues, we could see a lower high over here, or maybe at most a retest of this swing high around 1520 over here. Yeah, if the current downtrend momentum actually holds. Okay, then some more Hong Kong counters, the HSI Management Tech Index ETF. So for this, we saw a breakout above this resistance area of around 4.2, 4.3. Currently price tested up to about 4.65. So at these levels, we are near the swing high form in January over here, which is around 4.7 to 4, close to 4.8. So I think in terms of resistance, why we could be quite near if we do test this level. Yeah. And we could see some form of pullback if we do consolidation, if we do see this level, which is and then current support wise, I think we could see maybe at around 4.5 over here. The next one is Tencent Holdings. So for Tencent, in terms of technicals, we actually broke out of this wedge over here, this wedge. So looking good. Near term, there's some resistance at this swing high 364 as well as previous this key horizontal level around 370. So if you go up, if price does go up to test, expect some resistance, but I think we could see some higher lows being formed if this breakout does hold. Then if the breakout holds, then maybe the 348 about 353 this region will be able to hold as a support. Okay, the next one is Ping An Insurance. Ping An Insurance also broke above this horizontal level, $53. Currently, we are at around 56.5. So I think if the uptrend momentum continues, we could still see price maybe test this swing high around 59 to about close to $60 over here. Okay, then JD.com. JD price also currently tested this swing high 159 today. Currently trading in this, possibly trading in this uptrend channel. So if you do hold this level, I think there could still be a little bit of an upside to maybe test 170 to 173. This area, which is the channel risks as well as this swing high. This was back in March of this year. The next one, Industrial and Commercial Bank of China. For today, there looks to be a breakout of this wedge pattern over here. Also, it took out this 3.78, 3.8 previous support and resistance. So if it's able to hold at this level, I think there could be some upside to come to maybe test 4 to about 4.1 over here. So looking at the longer term charts wise, it could go on to test this key downtrend resistance line over here, possibly if it goes up, which is around 4.1 over here. Okay, then I'll talk about the other two Singapore banks. So first up is DBS. So DBS broke out this key resistance level 3280. Currently, we are quite near the previous highs, around 34.50 to about $35. We expect some resistance over here. So next one is UOB. Similar thing for UOB. We're also quite near the highs over here, around $30.50. So over here, this level at 30.20 to 30.50, we expect some resistance coming at these levels. I see a question on the ISDN. For ISDN, I think currently the test of this uptrend support line is still holding. So over here, since the COVID lows has been holding this uptrend support line for a test of 4 times. Price is still holding over here. So currently it looks like a bounce to test short-term resistance around 45 cents. If it's able to hold this support or form a higher low, I think there's a chance for some bullish reversal if you do reverse down back up from this zone over here. And then some TA for the ASX counters. So first one is the ANZ group holdings. For this, in terms of technicals, it's trending pretty well. In this uptrend over here, we took out this $25 swing high and actually did a retest. It was supported. So if there, I think there could be some further upside to test this key resistance around $26. We saw price tested about 3 times over here, and then in format resistance. So there could be some little bit more upside over here for ANC. And next one is Flight Centre. So in terms of Flight Centre wise, also uptrend over here, we actually tested this resistance at 23.30 today. Even there is the third time we are testing it, there could still be some resistance over here, but if you do form a higher low, if you do consider form a higher low, let's say within the area of 22 and above, which is this recent resistance, I think there's still a chance that price could go on to try to trade higher and maybe eventually test the high end of resistance at 25.30 over here. Okay, then I'll take a question on Hong Kong Land. For Hong Kong Land, I think it's still quite bearish. We're still trading well in this downtrend channel over here. So in terms of support wise, I think the next support we could probably see maybe at around 345 maybe. The next channel support confirmed with the previous horizontal resistance over here. And then Mapletree Pan Asia Commercial Trust currently looks like we are trying to test the resistance of this downtrend channel over here. Price has actually just formed a sideways pattern between about 164 to about 170 over here. If you do hold this level at 164, which was this prior resistance over here, where before we formed this range, if it's able to hold this support, then there's a chance for possible breakout for price to trade higher over here. If not, likely we will trade back down within the channel itself. Yeah, to maybe 160. I think Yeah. Maybe I cover one more in view of time. I'll talk about Parkway Life. Okay, so for Parkway Life, I think currently price has just been sideways over here. The support over at 360, 367 is still holding, and recently looks to have a possible breakout of this downtrend resistance line, price testing the recent swing high around 390. So looks a bit bullish for now. If you can take out this level and hold at a higher low over here, if you do back test, then I think price might go a bit higher to trade around 405 in the near term, which is next resistance. Okay, I think that's all from me for technicals today. I have my time to my colleagues if they have any more questions to answer. Unfortunately, can't cover all the TA questions. Can actually post them in the P3 community if you're interested. Yeah, thanks.
Yeah, thanks Zain for the TA part. Yeah, so sorry, there's still some questions, but we do not have time. We try to end the webinar at 1. So if you have any further questions that we've yet to answer, yeah, please feel free to just drop it in the P3 community. Yeah, so as usual, thanks for your questions and hope to see you next week. Bye-bye.